We are officially in a bear market, and investors are wondering what happens next. As we look at the tail of the past week, the S&P 500 officially entered into a bear market, down 20% from peak to trough. The NASDAQ officially entered crash territory, down 30% from its peaks. Yes, at the end of the session, they paired some of those losses and parked their heads right above some of these key levels. But a range of macroeconomic uncertainties still persist. As we can see on the CNN's Fear and Greed Index, we're now in extreme fear territory. And I'm sure if you just talk to the people around you, you read publications, watch videos, there's so much uncertainty and fear permeating throughout the markets. From growth scares to earnings results, some insights from some leading global blue chips, inflation news, and of course an election to discuss. There's a lot for us to unpack in this weekly wrap. Enjoy. So where to start? I think it's worth talking about growth, and we got some really fascinating insights from Target and Walmart, which we're going to dive into and unpack. But first and foremost, we have to think about where the state of the economy is. The consumer has been strong. We know that demand destruction has been a concern as rising input costs and inflation continues to flow through the economy. But household balance sheets were resilient and they were built up during the past period, of course supported by ultra-loose monetary policy and fiscal stimulus. But we know that there's been rising input costs from supply chain bottlenecks, the Ukrainian situation and everything playing out in Europe, and more recently, the China lockdowns as well. So far, it seems like the plan that the market's been watching for has been for companies to absorb some of these costs and for consumers to absorb some of these costs as companies pass these costs on. And particularly during the first quarter of results, we didn't see significant demand destruction. But recently, we've seen a couple of interesting results, which is leading to uncertainties about where growth, and of course, with a tightening monetary policy, where that leaves growth moving forward. So with some of these results, we saw that the top line was good, but it was the margins and profitability took the hit. We also saw some change in consumer patterns with a shift from goods-focused spending towards more services-based. And now when we think about both Target and Walmart, staples, as we know, they're normally a safe haven, especially during times of uncertainty. It's not often that you'll see leading global blue chips in the consumer staples sector falling by 11% in a single session, or even further by 25% in a single session. But we saw both of these things play out over the past week. But beginning with Walmart, first and foremost, we see here with Walmart, higher costs, supply chains, inventory issues, all of the same themes flowing through, both on the Walmart and Target front. Cost pressures included inventory, fuel and logistics prices, and overstaffing. Interestingly, they actually raised their top line forecast, but lowered profit, and their shares were down by over 11% on the day. But investors and analysts were really looking to see whether this was isolated to a Walmart company-specific problem or if it was a sector-wide issue. And then we got the Target response the following day. The shares were down by over 25%, over $20 billion of market cap wiped out in a single session. There were similar concerns surrounding costs and inventory. A change in consumption patterns was highlighted from goods to experience-based, which aligns with that discussion we had earlier about the services transition, particularly as economies reopen. We know the market's been scared about a growth scare to go with these inflation pressures, particularly with a tightening process. And so, of course, we'll look for results from this Q2 and Q3 for the calendar year to give us more insights about where things are tracking. Really flowing on from this, we got some manufacturing activity data. If you're wondering why it's interesting to look at the manufacturing activity, it can often serve as a leading indicator for broader economic activity, which makes sense because manufacturing is such a key component throughout the supply chain. But starting with the New York State manufacturing activity, it was the second contraction in 3 months. But it's really looking below the line as to what actually happened that raised a few eyebrows. So the General Business Conditions Index of Manufacturing Activity, that headline figure, shrunk over 36%. Last month, it was at 24.6 positive, and it shrunk to negative 11.6, which was well below any forecast or expectations. To give you an insight into this, consensus was for a positive 17 print. Labour conditions remained relatively strong. Interestingly, we saw a slight easing in input costs, which feeds into the potential peak inflation discussion. And then the Philadelphia manufacturing numbers followed on from that. These are closely watched, as we know. Similar trend, 17.6 in April, positive print, dropped to just 2.6, with consensus expectations of around 16. Price pressures also eased with this set of data from 84.6 to 78.9. And so it's really starting to throw up a few really interesting data points for the Federal Reserve and other central banks around the world. Of course, inflation's a key component in the mix for all of this. We had a range of different data prints over this past period, starting with the UK inflation, a 9% CPI inflation figure, Just that alone raises a lot of eyebrows, but interestingly, it was actually below the 9.1% that was expected. We, of course, saw significant increases in energy prices, and this drove it to 40-year highs for inflation in the UK. Canada's inflation rose to 30-year plus highs to 6.8%. And on an Australian front, we actually got some figures as well. We got some insights into the RBA meeting minutes from their recent rate rise meeting. This was a key insight into the decision and the focus on how they chose to raise rates. If you are interested in getting some more insights into this itself, we actually did a deep dive video, which we'll leave a link to up above, that you can check out after this one. On the Australian economic front, we got a number of interesting numbers, which were quite a fascinating lead into the election, which we'll talk about later in the video. Unemployment, 3.9%, a 3 handle in front of it, the lowest level since 1974. Jobs data, we actually added less than anticipated. Consensus was for around 30,000 jobs to be added. We added 4,000. Wages data, 2.4% year on year, 0.7% for the quarter. However, when you're stacking it up against a headline figure of inflation with a 5 handle in front of it, we're seeing significantly negative real wages. And the RBA will be watching and hoping for a sustained uplift in wages, particularly with the tight labour market that we have. And now, just before we talk about the election, an interesting governmental development on that front, especially with the interest in the EV battery material space, is there was an MMI grant for Pilbara and Calix, ASX PLS and ASX CXL. The MMI grants are the Modern Manufacturing Initiative. These are an interesting set of grants that can be provided. If you're interested, we've done another video on this as well, which you can check out here. But the key facts for this grant that was provided was for $20 million to support the development of their proposed joint venture for their lithium midstream project. They're developing a demonstration scale chemicals facility to produce lithium salts as a value added midstream project, and of course made in Australia, where we know the focus is on onshoring activity, particularly for some of these more critical minerals. And that leads us to the election. At this stage, at the time of recording, Labor is in charge and is on track for a majority government. It will be a change of leadership, and the nation will wait to watch how this goes if it plays out. It's of course definitely interesting, and there's a range of different policy lenses to look at it from, particularly from the climate change, decarbonisation trend. There's going to be a range of implications, and we know how ASX investors love the EV battery materials supply chain, including lithium, graphite, nickel and cobalt. Everyone's got mixed opinions on this. I'd love to know your thoughts and what you think this means for the future of the economy moving forward. It of course is still contingent on how the vote plays out and where the final seat allocation lands. If you're interested in more macroeconomic discussions, here's some other videos you can check out. Big thanks for joining us. For now, stay well and happy investing.